Hello everyone, and welcome back to Virginia International University's MBA 610 Taxation of Business Entities class. In this session, we're going to be talking about compensation planning. So far, and up to this point, what we've really been looking at and studying and talking and reading about has been the basic framework of effective tax planning and in a global environment. So now we want to turn to the application of this framework to specific topics. And in this topic, we're going to talk about employee compensation planning. And again, keeping in mind the themes that we've talked about throughout the semester thus far, that there's more than one party to each transaction. And so we want to, in effective tax planning, we want to keep all the parties to the transaction in mind, and what the effect of, or the tax implications of the particular tax treatments of the transaction means to all of the parties, right? And then we also want to remember that there are always certain non-tax features to our tax planning alternatives. And so, we don't want to overlook and ignore the other important considerations to the decision aside from the tax consequences, which is what we would generally focus on. So let's look at the different types of compensation first. And so from table 8.1 in the text, you can see that there are different compensation alternatives. So down the left-hand side in blue, we see the category. So what we can do is to pay compensation either through non-taxable fringe benefits, through pensions, incentive stock options, deferred compensation, restricted stock, non-qualified stock options, stock appreciation, performance, shares, units, or cash salary, and cash bonuses. And, again, looking at it from all parties, and in this case it's the employer-employee party, we can see what the tax effects of those are. So for employees, non-taxable benefits are never taxed, right? I mean, if our employer, generally speaking, if our employer pays for a portion or all of our medical care or policy premiums on our medical insurance or life insurance or dental, we don't have to claim that as tax, except in the specific case if the life insurance the employer is paying for has a value of greater than $50,000, there is imputed income that is imputed to the employee and shows up on their W-2 as additional income. But that's a specific case. And then from the employer's perspective, the fringe benefits are immediately deductible for tax return purposes. So for pensions, and we looked at pensions and types of pensions when we looked at investment alternatives in an earlier chapter, and we said that or investment vehicles, and so we see that with pensions the tax is deferred, right, on the investment return, and then sometimes there are the contributions that are made to them are deductible and sometimes they aren't from the employee's perspective, right? So it may be that our initial contributions into the plan are deductible, and maybe that they aren't, but it is that what's earned on the plan assets over the life of the plan is non-taxable to us until we start to withdraw, in most instances, except for, as we talked earlier, a Roth IRA. Right? But from an employer's perspective, the contributions to pension plans that they make on behalf of their employees is immediately deductible. So with incentive stock options, the employee tax effects are that they are deferred tax at capital gains tax rates, unless we take a particular Section 83B election. But from a employer perspective, they're never deductible. Right. So with respect to deferred compensation, it's deferred at ordinary rates, which means that the employee will recognize the compensation as ordinary income and pay ordinary tax rates on the income when they receive it, which may not necessarily be in the current period. And it's at that time, which would not be the current period, that the employer would also be able to recognize it as a deduction. And we see that theme is consistent between deferred compensation, restricted stock, non-qualified stock options, and stock appreciation rights, and then performance shares. So then we get down to cash salary, where, if I get, that's my salary. I get paid that every 2 weeks, once a month, once a day, however often I get paid it, and I'm immediately taxed at ordinary rates on it, right? And before I get it, I've been essentially taxed on it, and then at the end of the year when I file my return, I true it all up, right? And from an employer standpoint, they're immediately taxed on it. And then there's the idea of cash bonus, right? So again, when I'm paid that, I'm immediately taxed on it at ordinary rates, and the employer is able to take that immediately as a deduction. So these are the different categories or compensation alternatives, and we'll talk a little bit about each one of these and some examples of them. And many HR experts believe that these are ordered in terms of decreasing desirability, right? So it is saying that cash bonus and cash salary are least desirable from an employee standpoint because they are immediately taxed on them, and there's a loss of economic benefit, and with there being no other type of compensation in the plan as well. Clearly, one would argue that, well, I have to live and I have to eat while I'm living, and I have to have a roof over my head and meet expenses and so on. And so there has to be an element of cash salary to my compensation package, or I don't have what I need to live on. But that element, for highly compensated folks, that element is generally a small part of what the total compensation package is, in order to help them control the tax consequences of that. So when we talk about deferred compensation, we talk about it in two different types, right? It's either qualified deferred compensation, which means the compensation is made available to all employees, or it's unqualified deferred compensation, which says that it's this compensation package or schema or contract is only made available to key, highly compensated, or top hat employees. And that's often referred to as inside debt. And we'll talk about that for a second too later. And specifically, deferred compensation is really just a contract between an employer and an employee. The employee can arrange to save for future consumption, right, by agreeing to defer the receipt of current compensation until a future date. So the employee is essentially giving up, current consumption in lieu of future consumption by providing a stream of inflows at a later date. The employer deducts the compensation when paid in the later period as well, and the employee includes it in taxable income in the later period when received. And so the attractiveness of deferred compensation is really highly dependent on the expected tax of the individual and the organization. So deferred compensation is favored by an employee when tax rates are expected to decrease in the future, right? Because if I expect that my tax rate will be 35% next year, or 2 years from now versus the 39% that it is now, then I would favor deferred compensation, because when I do get paid it and have to claim it as income taxed at an ordinary tax rate later, then I'll be paying a lower tax on it. It's favored by the employer if the employer's tax rate is expected to increase in the future, right? So if I'm an employer and I know that my tax rate is going to increase in the future, right, then I would also want to institute deferred compensation as much as possible. So there are some other, we want to always talk about non-tax factors, right? So there's these other non-tax factors also impacting the compensation costs, right? So what are the goals of the incentive contracts between employee and employer, right? That's really, the compensation package should be support and reflect the goals, right? The one problem with the deferred compensation issue is that employees really become an unsecured creditor of the company, because the employee is now owed the deferred compensation package from the company. So that's this idea of inside debt, right? The employee is an employee of the company, right? So they're in the company, and they are really carrying the company by having the company having a receivable balance, if we think about it from an employee standpoint, a receivable balance due from the company. And so, what happens if the company goes bankrupt? Well, the employee just doesn't get their deferred compensation, versus having taken the compensation in the current year and paying perhaps a higher tax on it, or foregoing some of the advantages of deferred compensation. So that's a risk. And so again, when we talk about risk, right, that becomes one of those implicit costs of the transaction. Then there are compliance costs, right? And with respect to compliance costs, we're always thinking in terms of Section 409A, which was added to the tax code as part of the American Jobs Creation Act of 2004, which was partially in response to Enron executives accelerating payments before bankruptcy, compensation payments, really. This code section places significant restrictions on the timing of contributions, restrictions on the acceleration of benefits, significant restrictions on the timing of distributions, restrictions on deferral elections, and other penalties for violating the requirements, and they are severe. And so there is there are significant compliance costs associated with this deferred compensation scheme. And then we also want to keep in mind that not only are the tax rates important, but uncertainty about tax rates and income levels make the decision more complicated. So there are a lot of non-tax factor consequences that also have to be considered when we're negotiating compensation contracts, regardless of which of the compensation alternatives they may include that we looked at on our first slide. So another alternative was this idea of salary versus fringe benefits, right? And this comes in with respect to whether employees can deduct on their own tax return the cost of fringes they pay for themselves, right? Or the extent to which employees place personal value on employer-provided fringes relative to their cost to the employer. And so these are things that employees have to weigh, and companies need to understand how employees weigh these. Recognizing whether providing a sweetened fringe benefit package in lieu of some salary that may or may not be taxable to the employee is enough to incentivize the employee to perform. And so another compensation arrangement that could satisfy the demand for flexibility when tax rates change unexpectedly over time is a bonus plan. And this is where the bonus is paid at year end, and the amount of the bonus is at the discretion of the compensation committee of the board of directors, rather than being set by some pre-specified formula. These plans are very common in practice, but they're really used more for incentive reasons than for tax planning reasons. And they do require a lot of mutual trust between the employer and the employee. They can also be timed strategically to coincide with high tax rates for the firm and low tax rates for the employee. And this means really knowing about does the tax law mean, and any changes in it in the coming year, to where I accelerate a payment in the current year under a bonus plan, or I don't accelerate it, in fact pay it out the following year. And the readings give some good examples of how Chrysler Corporation accelerated a 1990 incentive compensation to pay out to managers simply because of the 1990 Tax Act, and how the increase in tax that it would have generated for most executives. They compare this to the General Motors Corporation, which considered but rejected a proposal to make executive incentive compensations in December rather than January of 1991. And so then we want to also talk about this idea of stock-based compensation plans, also known as equity-based compensation. And there are 4 different types of those plans: employee stock options, stock appreciation rights, restricted stock, and long-term performance awards. And so, if we look back to our first slide, these were all in Table 8.1 as compensation alternatives. It's just these 4 happen to position themselves under an overarching commonality of being compensation plans that are rooted in the issuance of stock, essentially. And as you can imagine, there are certainly consequences of that or implications of that from the employee and employer's perspective with respect to taxes. So let's first talk about restricted stock. And so what restricted stock are, they essentially represent grants or awards to employees, right? And they allow the employee to receive some certain number of shares of stock, right? So they're granted X number of shares of a restricted stock that has a current stock price of some amount. Well, they are usually, the employees restricted from selling the stock until some later date, and that's referred to as a vesting date. And under a restricted stock grant, the employees don't recognize any income until the vesting date. And that kind of makes sense with some of the other theory we talked about, is that there has to be an economic ability in order to pay tax associated with the transaction. And so simply granting the stock to the employees doesn't equip them with any additional cash in order to pay any tax liability. But after they've reached the vesting date, the amount of the taxable income is the value of the stock on the vesting date, right? So suppose that I worked really hard, and my employer wanted to incentivize me or compensate me for my hard work, and so they said at the end of the year, we're going to grant you 1,000 shares of stock in the company. And on that date, the stock was worth $20 a share, so $20,000 worth of stock. But the vesting period is a year, so you can't really do anything with it or about it for another year. And so at that point in time, there are no tax consequences to me. I really didn't realize any economic benefit as a result of that grant. And I certainly didn't realize any ability to pay a tax liability associated with it. However, a year from that date, after the vesting date, and suppose on the vesting date, the each share of stock was selling for $30 a share. Well, on the vesting date, I then have $30,000 worth of income, because then the stock is mine, right, to do with as I please. And so at that point in time, I do have a $30,000 liability, but I invested in the stock, it's mine. And if I want to sell it, depending on, some companies under restricted stock say, well, you have to sell it back to the company if you want to sell it, or there are certain rules around selling it if it was acquired as a result of a grant. The corporation receives a compensation tax deduction for income tax purposes equal to the amount of the income recognized by the employee. So the first year, the corporation would have gotten no income tax deduction, no expense deduction for compensation as a result of that. But at the end of the second year, when I realized my $30,000, the corporation would have realized their $30,000 deduction. And so that's it, this idea of restricted stock and how it works. Okay, and then finally, with respect to restricted stock, I also have an option under Section 83B whereby recipients of restricted stock can elect to be taxed on the value of the grant at the grant date, hereby referred to as the Section 83B election. Under that election, the value of the restricted stock at grant date is taxed as ordinary income, and any subsequent price appreciation or depreciation is treated as a capital gain or a loss, qualifying for favorable long-term capital gains tax rate, provided I hold the stock for more than 12 months. And so what we're really saying there is that I could take, upon receipt of a stock grant or a restricted stock grant, I could elect to take the value of the stock at the grant date and treat that as ordinary income at that time and pay tax on it. And then to the extent it appreciates over the next 12 months or between the time that I receive it and the time that I sell it, treat that differential as capital gains or losses if it depreciates, and have favorable tax treatment on that. And so then we talk about, well, when might an employee make this 83B election? And there we say that your intuitive answer might be when the employee expects the stock price to increase dramatically between the grant date and the vesting date, and then believes it's desirable to convert the future price appreciation from ordinary income to capital gains via this election. However, this election is a risky strategy. So if the stock price declines after the election is made, you pay taxes on this phantom gain, right? And so another type of compensation alternative is this idea of long-term performance awards. And they are one of the fastest growing types of compensation in the U.S. And really what we're saying is they can be in shares, units, or cash. And so it could be that, so a long-term performance award may be paid out to you in number of shares of stock or in dollars or in units of shares of stock, right? And it's what you are paid ultimately is, or what you earn is based on performance against some predetermined objective. And it may be that the metric against which these objectives are gauged are, did you reach a threshold? And so what is that? What is the performance award associated with the threshold? Did you reach a target? And what is the performance then associated with the target? And then the same with maximum. I've also seen this used where, well, here's what the budget is, here's what we expect you to perform, but also here's a stretch budget. With extra effort and with extra resource if necessary, here is something beyond the expected budget level that represents this stretch budget, and that would involve something like perhaps this performance award could be based. And so this may also involve a vesting period at the end of the performance period, right? So from a tax perspective, this compensation is generally taxed to the employee when the contract is settled and the payment is made. And so there may be an appreciation between the payment and the vesting date and sale date, which becomes capital in nature, and the corporation recognizes the expense in the year the employee recognizes the compensation as ordinary income. And then one final important point here is that this section 83B election that we talked about with respect to restricted stock is not available for long-term performance awards. And so now we're moving on to the idea of employee stock options and stock appreciation rights. And when we think about a stock option, it's nothing more than the right to acquire stock at a specific price, which we refer to as the exercise right, for a specific period of time, which we refer to the expiration date of the contract, right? So it's a contract. An option is a contract between the buyer and the seller that says, you're buying from me the right to buy stock at a certain price, the exercise price, and the period of this contract is for 12 months, we'll say. And so you can buy it at this price for the next 12 months. You don't have to, but you may. If you don't, you just let the option expire. Right? They're usually granted with a 5 to 10 year expiration date with the exercise price equal to the price of the underlying stock at the date of the grant, right? And so generally, the granting of the option is not a taxable event, right? So even if you were issued a stock option as part of your compensation package that said you're able to buy stock at the price of $15 per share, and you're able to, the exercise price, and you're able to do that anytime over the next 4 years, and that day the stock was trading at $20 a share, well, simply by being granted the stock option, it does not accrue any tax liability to you, right? Now, if you immediately went out and bought 100 shares of stock that you could buy for $15 and immediately in the next hour sold those in the open market for $20 a share, then you obviously have some capital gains there, which likely would be treated as under capital gains rates, although not long term. And that's why we say that just simply the granting of the option is typically not a taxable event. Then we talk about stock appreciation rights, and stock appreciation rights as a as a part of a compensation plan provides employees with cash payments equal to the change in market value of a firm's stock over some specified period of time, right? So it may be that the company says, well, if our stock goes up, 2% in value, you will immediately be eligible to receive a $10,000 bonus or a $15,000 bonus. So they tie the amount of the payment to the change in the market value of the firm's stock over some specified period of time. And this really is intended to create some sense of ownership on behalf of management in the stock performance. And so now let's talk a little bit about this idea of non-qualified stock options or incentive stock options. So non-qualified stock options, the employee would recognize ordinary income on the difference between the stock price on the exercise date and the exercise price determined at the grant price. It gives rise to an employer ordinary tax deduction at the same time and amount as the ordinary income recognized by the employee. This versus an incentive stock option where the gain at the exercise date is deferred until the stock is sold and then is taxed at the capital gains rate. And under the incentive stock option, the employer receives no tax deduction. And of course, it's important to keep in mind here that employee stock options are taxed differently around the world. So you need to know if and when the employee is taxed and at what rate. And if and when the corporation receives a tax deduction, which, as we said, may change depending on the location wherever I am in the world. So there are a couple of other influences of taxes on the compensation structure. One of them is this Section 162M, and what that does is to limit the corporate tax deductions for compensation to $1 million per person. And so that takes into account all of the types of the compensation alternatives that we talked about. Now, that's not to say a corporation, we all know and we've seen the headlines where some executive makes $100 million a year or $50 million a year. But the issue is that that company can only deduct $1 million per year from their tax return. And so this creates differences between the financial statement income and the tax return income. Generally, these are going to be permanent type differences versus temporary, and we'll talk about those later. But we do have this $1 million per individual deduction limitation for tax purposes. And we can avoid this limitation, though, by qualifying for the performance-based exception. And in order for that to happen, again, the compensation must be linked to the executive's attainment of objective performance goals. The goals must be set by the compensation committee of 2 or more independent directors, and the shareholders must approve the compensation plan. And then the compensation committee must also certify that the performance goals have been met before the payment is made. And so, we talked a lot about compensation. I think we've covered a lot of the general practices in the industry. We've looked at the different compensation schema, and none of these have to necessarily be only one. It could be, and generally is, a combination of multiple different compensation schemas because of the tax consequences of all of the different, or the individual schemas. And so it's also, you can appreciate the complexity where where you have a cash component, where you have a stock option component. Part of it may be a performance-based component. Part of it may be a restricted stock. Part of it may be stock options or stock appreciation rights. And so, when the more you layer this on, the more complex it becomes with respect to both accounting and tax. But at the end of the day, you may also have a more equitable compensation plan. So please go back and read the text. I know there are a lot of formula, algebraic equations in there, but please read the text and make sure you understand the theory behind this. And I don't expect that you're going to remember all the theory and the calculations, but I would like, and I think it's a good idea as professionals, that you have a good feel and have some vernacular around the different compensation methodologies that are available. And because of this class, some appreciation of the tax complexities associated with them. So thank you for your time, and I look forward to talking with you in our next session.